This time, what we're going to take a look at right now is we're going to take a look at super variable costing. So this would be Appendix 6A. So what we'll do is we'll prepare an income statement using super variable costing, and then we will reconcile this approach with variable costing. So what is super variable costing? Super variable costing, what it does is it classifies all direct labor and manufacturing overhead costs as fixed period costs and only direct materials as a variable product cost. To simplify, in this appendix, we also assume that selling and administrative expenses are entirely fixed. So the unit product cost only consists of our direct materials in super variable costing. And again, our direct labor, our fixed manufacturing overhead, and then any of the variable and fixed selling and administrative expenses would be treated as period costs, and they would get deducted from revenue as they're incurred. And this is opposed to our variable costing, where the unit product cost consists of direct materials and direct labor costs. And our fixed manufacturing overhead and all selling and administrative expenses are treated as period costs and deducted from revenue as incurred. So that's what the difference is. So remember, super variable only unit product cost only consists of direct materials. Whereas in variable, it includes direct materials and direct labor. So that is your difference there. So let's again take a look at the Harvey Company and what they do. So we're going to assume that the Harvey Company produces a single product with the available information that as shown. So we see that they're going to make 25,000 products. The variable cost per unit is $7. Of that, of course, in this case, because we're looking at super variable, is only in the direct material. And in our fixed costs for the year, we're 75,000 in direct labor, 150,000 of manufacturing overhead, and 100,000 of selling and administrative expense. So the unit product cost under super variable and variable costing would be $7 and $10 respectively. So again, under super variable, it would be $7 because we're only looking at materials. Under variable costing, it would be 10 because you have direct materials and then you also have labor cost. Now, so again, under super variable costing, we only would have direct material cost that would be included in the product cost. Under variable costing, direct material and direct labor would be included. So that's again, your distinction there. So our income comparison. So again, here's some additional assumptions about the Harvey Company. 20,000 units were sold during the year. The selling price per unit is $30. And then we, again, had no beginning inventory. So now we'll compute the net operating income using both super variable and the standard variable rate. Again, for super variable costing contribution, how we take a look at that. So again, the unit product cost is $7, and all 75,000 of direct labor is expensed in the current period. And so the net operating income is going to be should say there 135,000. Commas there that are not in the appropriate locations there. But again, so it should say 135,000 because you have 600,000 of sales less your variable expenses, 140,000, which is $7 times the number of units, which is the same as the direct materials. So the contribution margin was 460,000. And then less, again, all of the fixed expenses, so the direct labor, then fixed manufacturing overhead, and then fixed selling and administrative. expenses. So our net operating income should have been 135,000. Now, under variable costing, where the unit price was $10, because remember, you have the cost of the materials plus the cost of the direct labor associated with it. You would have net operating income of 150,000. So comparing of the two methods. Under variable costing, 60,000 of direct labor is included in cost of goods sold, and 15,000 is deferred in ending inventory as an asset on the balance sheet. Under super variable costing, the entire 75,000 of direct labor is treated as a period expense. The super variable costing ending inventory is $15,000 less than the variable costing, thus explaining the difference in net operating income between the two methods. The difference in operating income between the two methods, which is 15,000, can also be reconciled by multiplying the number of units in ending inventory, which is 5,000 units, by the direct labor cost per unit, which is $3. That is deferred in ending inventory under variable costing. And we can look at an extended comparison of income data. So two additional assumptions and facts about Harvey are that they had 30,000 units that were sold in year 2. The selling price per unit, variable cost per unit, and the total fixed costs and number of units produced remained unchanged. And they had 5,000 units in their beginning inventory. And so you have the unit cost computations. Since the direct material and direct labor cost per unit remain unchanged, the unit product cost computations also remain unchanged. So it will work out the same regardless. And then for super variable costing, the unit product cost is $7. All 75,000 of direct labor gets expensed within the current period. And so the net operating income would be 365,000. And then in variable costing, the unit product cost is $10. The the direct labor cost released from inventory is 15,000. And so the operating income then under variable costing is 350,000. And so again, comparing the two methods, the difference in net operating income between the two methods, which is 15,000, can be reconciled by multiplying the number of units in beginning inventory, which is 5,000 units, by the direct labor cost per unit, which is $3, that is released from beginning inventory under variable costing. Across the 2-year time frame, both methods would report the same total net operating income of $500,000.